There is a lie that has been whispered into your ear since the day you earned your first dollar. It is a quiet, insidious lie that keeps millions of people stuck in the rat race, working until their backs give out and their spirits break. You hear it at dinner parties, you see it in movies, and you feel it every time you look at your bank account. The lie is this: investing is for the rich. We are told that the stock market is a velvetroped club for men in $1,000 suits, screaming into telephones on Wall Street. We are told you need $10,000, $50,000, or $100,000 just to get a seat at the table. And because we believe this lie, we do the safe thing. We put our money in a savings account. We let it sit there safe and sound. But here is the terrifying truth they don't tell you. While your money sits safe in that bank account, it is slowly dying. Inflation is eating it alive, invisible and silent, year after year. By doing the safe thing, you are actually guaranteeing that you will become poorer. What if I told you that you could own a piece of the biggest companies in the world? Apple, Microsoft, Amazon, for the price of a couple of lattes? What if I told you that the barrier to entry isn't $1 million, but literally the loose change in your pocket? The gatekeepers have vanished, the walls have crumbled. In 2025, the most powerful wealth-building machine in human history is unlocked and wide open. But most people are still standing outside, too scared to turn the handle. Today that changes. We are going to shatter the myth that you need to be wealthy to invest. In fact, we are going to prove that investing is the only reliable way to become wealthy in the first place. I'm going to walk you through exactly how to go from zero knowledge to owning your first asset. We are going to strip away the jargon, the confusion, and the fear. You don't need a finance degree, you don't need a trust fund. You just need to listen and you need to take action. This is not a drill, this is your financial future on the line. Let's walk through the door. To navigate this world, we first need to speak the language. And don't worry, we aren't going to bore you with textbook definitions. We are going to look at this the way a business owner looks at it. When people hear stock market, they usually think of one thing: picking the next winning stock. They imagine buying shares of a tiny tech company today and waking up a millionaire next Tuesday. While that makes for a great movie, it is a terrible strategy for a beginner. We need to distinguish between two main characters in your investing story: the individual stock and the ETF. Imagine you want to buy a lemonade stand. If you buy one specific lemonade stand on the corner of 5th and Main, that is like buying a stock. You are betting everything on that one stand. If the weather is hot, the lemons are fresh, and the neighborhood kids are thirsty, you make a fortune. You own a piece of that specific business. When they profit, you profit. But what if it rains? What if the city does roadwork in front of the stand and nobody walks by? What if the manager forgets to buy sugar? If you only own that one stand, your entire investment goes to zero. It is high reward, but it is incredibly high risk. Buying a single stock, like buying just Tesla or just Netflix, is betting on a single horse in a very crowded race. If that horse breaks a leg, you are out of the game. Now imagine a different approach. Instead of buying that one lemonade stand, imagine you could buy a tiny sliver of every single lemonade stand, coffee shop, burger joint, and taco truck in the entire city. Thousands of them. If the lemonade stand on 5th and Main has a bad day, it doesn't matter, because the coffee shop on 6th Avenue just had a record-breaking morning. If the burger joint goes out of business, the taco truck is expanding. By owning a piece of everything, you eliminate the risk of a single failure destroying your wealth. This is an ETF, or exchange-traded fund. Specifically, we are talking about index funds. An ETF is like a basket. Inside that basket are hundreds or thousands of different stocks. When you buy one share of an ETF, you are instantly buying a microscopic piece of all those companies at once. You aren't betting on one horse, you are betting on the entire racetrack. The most famous version of this is the S&P 500. This is a list of the 500 largest, most profitable companies in the United States. When you buy an S&P 500 ETF, you are buying Apple, Microsoft, Google, Facebook, Exxon, Coca-Cola, and 494 others. You are betting on the American economy itself. For a beginner, the question isn't which stock is going to the moon. The question is, do I want to gamble or do I want to invest? Individual stocks are for speculation. ETFs are for wealth building. If you want to sleep well at night, knowing your money is growing even if one company fails, ETFs are your best friend. They are the vehicle that will carry you to financial freedom. But a vehicle is useless without an engine. And the engine of investing is something so powerful that Albert Einstein reportedly called it the eighth wonder of the world. We need to talk about compound interest. This concept is the reason why you don't need to be rich to get rich. It is the reason why time is more valuable than money. Let's play a game. I am going to give you a choice. Option A, I give you $1 million in cold, hard cash right now. Option B, I give you a single penny that doubles in value every day for 30 days. Most people operating on instinct grab the $1,000,000. It's $1,000,000, it's right there. The penny sounds like a joke. A penny doubled is 2 pennies, then 4, then 8. It feels like nothing. By day 10, you have $5.12. The person with the $1,000,000 is laughing at you. They are buying a sports car. You can barely buy a sandwich. By day 20, you have $5,242. Still not bad, but it's nowhere near a million. The millionaire is throwing parties on a yacht. You are driving a used Honda. But then the magic happens. The curve starts to go vertical. On day 28, you have over $1.3 million. You have passed them. On day 29, you have $2.6 million. And on day 30, that single penny has grown into $5,368,709.12. You have 5 times more money than the person who took the million. This is the power of compounding. It is not linear, it is exponential. Now, obviously, the stock market doesn't double your money every day. That's a fantasy, but the principle remains exactly the same. Your money earns money. Then that new money earns more money. Let's look at a real-world example. Let's meet 2 friends, Jack and Jill. Jack is the responsible one. He starts investing at age 25. He puts $200 a month into the stock market. That's it, just $200. He does this for 10 years until he is 35, and then he stops completely. He never adds another dime. He just lets that money sit there and grow at an average market return of 8% until he retires at 65. Jill is a bit of a procrastinator. She wants to live her life first. She waits until she is 35 to start, but she knows she is behind, so she tries to catch up. She invests the same $200 a month, but she does it for 30 straight years, from age 35 all the way to 65. So let's look at the inputs. Jack invested a total of $24,000, $10 years x $2,400 a year. Jill invested a total of $72,000, $30 years x $2,400 a year. Jill put in 3 times more money than Jack. She worked 3 times as hard. Who has more money at age 65? Jill has roughly $270,000, not bad. But Jack, the guy who stopped saving 30 years ago. Jack has over $315,000. Jack put in less money, spent less time stressing, and ended up with $45,000 more than Jill. Why? Because his money had 10 extra years to compound. Those first 10 years did the heavy lifting that Jill could never catch up to, no matter how hard she tried. This should scare you, but it should also liberate you. It means you don't need a high income to win. You just need to start. A 19-year-old working at Starbucks who invests $100 a month will likely end up wealthier than a 40-year-old doctor who waits to start investing $1,000 a month. Time is your greatest asset, not your job, not your degree, not your IQ, time. And every day you wait is a day of compounding you can never get back. So you understand the vehicle ETFs and you understand the engine compound interest. Now you need the keys. You need to know how to actually physically do this. It brings us to opening a brokerage account. This is the part where people freeze. They imagine mountains of paperwork, fax machines, and confusing phone calls. In reality, opening a brokerage account in 2025 is easier than ordering a pizza. It takes about 10 minutes and you can do it from your phone while sitting on your couch. A brokerage account is simply a bank account that allows you to buy assets. When you put money in a regular bank, it sits there. When you put money in a brokerage, it sits there until you tell it to go buy something. Here is the step-by-step process. Step 1. Choose your broker. You want a platform that is reliable, low-cost, and easy to use. In the US, the big players are Fidelity, Vanguard, and Charles Schwab. These are the titans. They have trillions of dollars in assets. They aren't going anywhere. For the younger, mobile-first generation, apps like Robinhood or Webull offer incredibly slick interfaces. They make investing feel like a game, which has its pros and cons, but they are legitimate, regulated brokers. My recommendation: if you are investing for the long term, which you should be, stick with the established giants like Fidelity or Schwab. They offer excellent customer service and zero fees on stock trades. Step 2. The application. You will go to their website or download the app. You will click Open an account. They are going to ask for some personal information. This is standard Know Your Customer (KYC) law. They aren't being nosy. They are required by the government to verify you aren't laundering money. You will need your social security number or national ID if you are outside the US, your address, and your employment info. Pro tip: you will likely be asked what type of account you want. For most beginners, you are looking for an individual taxable brokerage account. However, if you are investing specifically for retirement, you might want to look at a Roth IRA. A Roth IRA is a magical account where you pay taxes on the money now, but when you pull it out in retirement, it is 100% tax-free. All that growth, all that compounding, the government doesn't touch a penny of it. If you qualify, open a Roth IRA first. Step 3. Link your bank. Once the account is open, it will have a balance of $0. You need to fund it. You will link your regular checking account just like you would for Venmo or PayPal. Transfer $100 or $50 or $10, whatever you have. Do not wait until you have enough. The habit is more important than the amount. Transfer the money. It usually takes 1-3 days to settle, though many brokers now give you instant buying power. Step 4. The most important step. This is where 50% of beginners fail. They transfer the money and then they stop. They think they have invested. They haven't. They have just moved cash from bank A to bank B. You have to actually buy the investment. You need to log in, search for the ticker symbol of the ETF you want, for example, VOO or VTI for total market funds, and click Buy. You will see two options, market order and limit order. A market order says, I don't care what the exact price is, just get me into the stock right now. A limit order says, I only want to buy if the price drops to X. For a beginner who is holding for 30 years, just use a market order. Don't stress over pennies when you are playing for millions. Execute the trade. Congratulations, you are now an owner of the global economy. Now, as we wrap this up, I know there is still a voice in your head. It's the voice of procrastination. It's saying, the market is too high right now, I'll wait for a crash. Or I'll start next year when I get a raise. Let me leave you with an ancient Chinese proverb that you have probably heard, but I want you to really feel it today. The best time to plant a tree was 20 years ago. The second best time is today. If you had started 20 years ago, you would be sitting in the shade of financial freedom right now. You would have options, you would have security, you wouldn't be worried about your job or the economy. But you didn't start 20 years ago, and you can't go back. Regret is expensive, but action is free. Every day you wait is a seed you didn't plant. Every day you wait is a branch of that compound interest curve that gets chopped off. You cannot control what the market does. You cannot control inflation. You cannot control the economy. The only thing you can control is when you start. Do not let perfect be the enemy of good. Do not let the fear of the unknown keep you paralyzed. You have the knowledge now. You know that you don't need to be rich. You know what an ETF is. You know the power of compounding. You know how to open the account. The door is open. The path is clear. Plant the tree. I'll see you in the next video. Step-by-step guide to buying your first stock. This video is relevant because it provides a visual walkthrough of the investing concepts discussed, reinforcing the step-by-step practical application for beginners.